All right, good afternoon, everyone. Welcome to today's webcast titled How to Effectively Time the Market Using VectorVest. My name is Brian D'Amico, and I'm the Manager of Educational Services here at VectorVest. I would like to welcome you all to today's live event. It is my pleasure to host the event for you. Today's speaker is Todd Schaefer, who is the Manager of Research here at VectorVest, and he's been with VectorVest for over 6 years now. And he's taught seminars all over the world, basically, on stocks and options. And he's one of our best speakers on market timing, so it's great to have him here with us today. So today, like I said, he'll be teaching us how to time your entries and exits based on our market timing signals. He'll show you when you should be in the market and when you should be out of the market. In addition, he's going to show you what to look for to determine market tops and market bottoms. Now, at the end of the webcast today, we are going to open it up for questions. So if you do have a question, you can feel free to submit it at any time during the webcast today using the little question box on your control panel. It'll appear in the upper right-hand corner of your screen. Now, as you see there, it'll look just like that. Now, sometimes it does minimize. Like if you don't type anything in there, after a while it'll minimize and it'll look like a little orange arrow in the upper right-hand corner. So if you just click that little orange arrow, it'll maximize that box again, and you can type in where it says enter a question for the staff. Now, during the webcast today, I'll be monitoring that chat box, as will Todd, so if he sees something in there that he wants to address during the webcast, he will. Otherwise, I'll be typing out responses to people as fast as I can, and then at the end, what we'll do is we'll see some of the common questions and ask those to Todd. So we'll get to as many of them as we can as time permits. At this point, it's now my pleasure to welcome Todd Schaefer. Welcome, Todd. Thanks for being here today.
Thank you, Brian, for getting the ball rolling here and that nice introduction. Welcome, folks. Welcome to what I think is one of our best presentations. And I guess you're always good at the things you enjoy most. So I very much enjoy giving this presentation. It's one of the presentations, or similar to those that we give in our two-day seminar talks. So just think of having 2 days of information like this that I'm about to share with you here today. I would suggest we put a little note up there. I would suggest that you take notes during this presentation. The biggest challenge for me today is that we normally would take about an hour to do this in live presentations, if you will, which is the whole time we have today. So I want to try to reserve some time for questions as well. So instead of me speeding up and running right past you, if you can, take some notes and capture some of those concepts, and then we'll be able to really nail them down for you. One of the reasons I like this talk so much is when I'm in front of a live audience, I see so many lights going off. You know, people all of a sudden have aha moments. So with that, I hope to have you join that club. Well, let's get started. So we're going to talk about how to effectively time the market using VectorVest. As you may or may know, or may not know, VectorVest believes it's our mantra that we want to buy rising stocks in rising markets and sell falling stocks in falling markets. Part of that approach is to make sure that we're looking for stocks that are safe and undervalued and have a lot of things going for them fundamentally as well as technically. But the most important thing, even more important than the stock strength itself, is what's going on in the market. The single most important thing to know, more important than stock selection even, is whether the market is going up or down, and I might add, or sideways. Everything follows from that. That's a quote from Dr. DeLito, and I'd like to amplify that, saying not only is it important to know whether it's going up or down, is it in an uptrend that's strengthening or an uptrend that's weakening? Very different scenario, right? As opposed to also is in a downtrend, but is that downtrend strengthening or weakening? So I'm going to show you this afternoon how you can determine the answer to those questions and therefore your approach to the market. The easiest way to do that, I think, is let's just jump into the program and let's get started. The VectorVest market timing system has 4 components. And we come up on the home page of our software, which we've just opened here, and this whole front page, well, most of this whole front page, is all about the current market timing system and the current market condition. Because again, you can be a lousy stock picker, but if you pick it in a rising market, you'll probably still make some money. Conversely, you can be a great stock picker, and in 2008 it didn't matter, right? So the market trend is the biggest driver of our success, and so we want to understand it and identify what the current trend is. Let's start by talking about the components that we use to analyze that trend. And they start right here. They're all identified in this little VectorVest at a glance box. So here we're just getting some working definitions, and we're going to start with the VectorVest composite. This is our broad index of the market. We calculate the VectorVest composite price by calculating an indexed average price of all 8,099 stocks that are in the database. And the reason we're including all the stocks is because we want to know what the broad market is doing, not just a slice of 500 or 30, right, as a representative of the whole market. And what this does for us is how many times, if you're watching the market, say, the Dow is up, but the NASDAQ is down. And so what are you supposed to do with that non sequitur in terms of what was the broad market movement? And so we calculate this VectorVest composite to give us or show us the direction of the broad market by virtue of its price. Our second indicator is the relative timing of that VectorVest composite price. This is the short-term trend analysis of that price movement. So now we're not looking just is it up or down, but we're saying what's the trend based on the magnitude of that move, if you will. It's cast on a scale of 0 to 2. 1 is neutral. So the lowest value is 0, which would be below 1 and therefore a downtrend. The highest value is 2, above 1, 1 being neutral, and therefore values above 1, you're in an uptrend. The closer you get to the extremes, the stronger the trend. So with a value at 0.96, you're just below 1, right? 0.04 of a point below 1. So essentially the market's been moving relatively sideways, slightly bearish or slightly downward. Our next indicator is the buy-sell ratio. As you may or may not know, every day VectorVest rates every stock in the database with a buy, sell, or hold rating. Generally, to get a buy rating, the stock has to have an RT score above 1, has to have some fundamental strength by virtue of a VST score above 1, but these are stocks with some fundamental strengths that are in an uptrend. Conversely, to get a sell recommendation, the stock has to be below its sell recommended or its stop price, which is a 13-week moving average price adjusted for the fundamental strength of the company. The short version of that is that to get a buy-rated stock, to get a buy rating in the VectorVest system, you got to have some fundamental strength and be in an uptrend. To get a sell recommendation, your price has to be lower on an adjusted basis than it was 13 weeks ago. That's a pretty good definition of a downtrend. The buy-sell ratio looks at the relationship between then buy-rated and sell-rated stocks within the database. And this gives you a feel for the internal strength of, okay, if the price is rising, am I getting more buys, right, more uptrended stocks along with that rise in price or not? I would expect more stocks to participate in that uptrend to be more bullish, if you will. Okay, so that's the buy-sell ratio. Currently at 0.91, so there are a few more sells than there are buys. Finally, the MTI, our market timing indicator. It's the smartest indicator in the box, in my view, and I'll show you why here in just a minute. But the MTI combines the price, the RT, and the buy-sell ratio into one unified indicator. So by looking at the MTI, we can see the direction, the magnitude, and the breadth of that price move. So we're looking at different aspects, if you will, of the market movement with those different indicators. We consolidate them into one indicator in the MTI. It's also on a 0 to 2 scale. 1 is neutral. So the underlying or long-term trend of the market, as designated by the MTI, at 1.01, we're just barely positive, right? So essentially the market moving flat on the longer-term analysis as well. So those are the indicators, the components that make up the timing system. And we went through there and explained their data points and how they're derived, but obviously it's even more important to understand how they're trending. Because if the MTI is at 1.01 but has been falling from a 1.5, that's very different than an MTI that's at 1.01 that has been rising from a 0.5. And so we need to understand how they're trending And so we turn to the first trend tool, if you will, the color guard here on the home page. The color guard is trying to analyze the trends of these indicators, not trying to, it is analyzing them, by looking at the change in the data point on both a week-over-week and a day-over-day basis. In other words, is the price of the VectorVest composite higher than it was a week ago? Is it trending upward in the middle term, if you will? And is it up day over day in the short term? If both data points rise, then you get a green color in this little tile in the cell. If they're both lower, as they are today, you get a red tile. If they're mixed, you get a yellow tile. When you do that analysis for the price relative to timing and the buy-sell ratio, you get this little stoplight of the market here, and you can tell very easily and graphically what's going on in the short-term trend of the market. Here we have a majority of yellow and red lights. We just added 3 more red lights to the top, which tells me then that I'm in a bearish condition that strengthened to the bear side today in the short term. When I look at the MTI, I can see that the MTI a week ago was at 1.14. Today it closed at 1.01. And it was downtrending, but it seems to have bounced off of its low from 2 days ago. So it's kind of holding steady. And we'll see this graphically here, where you start seeing some divergences happen between the price action and these other indicators, and they can help us identify turning points. This next column, the trend column, starts as our first look at some market timing signals, if you will. The first pair of initials is our primary wave, and we'll go over these again. But the primary wave is our fastest timing signal, and it's derived by looking at the price of the VectorVest composite on a week-over-week basis. Because it's higher, the primary wave, or I'm sorry, because it's lower, the primary wave is down. The second trend is our underlying trend, and because the MTI is above 1, it's currently up. And the final column is our slowest, most conservative timing call, the confirmed call, currently down. So that's the information we gleaned from the color guard. The market timing gauge at the top, and our guidance basically summarizes this top row of information, the most current information. And so it's all rules-driven. All of this is rules-driven, math-driven. Because we have 3 red lights in the color guard, the needle's all the way over in the red, and because the primary wave is down, we don't advocate buying any stocks. That simple sentence is going to make a lot of sense by the time we get to the end of this talk. So the color guard helped us with the short-term trend analysis, and it's a very kind of cursory graphic. Right away you can tell whether or not it's a bullish or bearish market condition. I don't see any green here, and I know right away intuitively that this is a bearish market condition in the short term. We turn to the market timing graph to graph all these components in the longer term. And so I'm going to click the graph tab, and I've loaded up a market timing graph. You choose it from this drop-down list. And I've set it up with a 1-year time frame. So I've got 1 year from edge to edge. And I'm looking at the components of the market timing system, the price of the VectorVest composite, the market timing indicator, the MTI, the buy-sell ratio, and the RT, the 4 components of that market timing system. Okay, so all we're doing now is we're going to look at the longer term trends of these indicators. And the first thing is, well, let's first define what is a trend. So an uptrend, I mean, intuitively say, okay, lower left to upper right. But we're going to find an uptrend as a series of higher highs and higher lows. That's an uptrend. A downtrend, if I drag to the left, is a series of lower highs and lower lows. And when I don't have either, it's sideways. Okay, so I have uptrends, downtrends, and sideways market movements, and they're all defined by that series of higher highs and higher lows. And I can analyze the trends of the MTI, the buy-sell ratio, and the RT in the same way. Am I hitting higher highs and higher lows? So that's trend, and that's what we're going to be looking for when we analyze each of these components. When we're doing that analysis, the market timing system generates a series of timing signals. And so we're going to talk about how we generate those timing signals and kind of the order in which they come. So the first thing I'm going to do is I'm going to change my graph from an end-of-day graph to a weekly graph for 1 year. And let's take off the MTI buy-sell ratio and RT. We're going to talk just about price action for a moment. When the VectorVest service first began, we were a weekly service. In fact, we used to be published in a little book, blue book called the Stock Advisory. One of the first things Dr. DeLito found when studying the price movement of the VectorVest composite on this weekly basis was he noticed that when the VVC went up week over week, it tended to continue going, if you will. In other words, it was up this week, tends to keep going. It went down this week, oh, it whipsawed. It went up that week though, so it continued going up. So the first study I want to do with you here is I'm looking at a 1-year time frame. We're going to open this up a little bit. So there are 52 bars. That might be a little bit over, but there should be 52 bars, with any luck, on this graph. You can try to make it exact, and you know it'll never work because whenever you try to make it exact, you can't. I'm in weekly mode. That's why. Okay, we're taking 11 months and 30 days. It's close enough. All right. So I've got 52 bars on this graph, and this is a study that you can do. The theory here, the concept is if the VectorVest composite goes up on a week-over-week basis, then it should do another one. So basically, anytime you see it go from green to red and then back to green again right away, even though actually this is a bearish candle, so that one's not a reversal. But when we see that, when we see it go up and then down and then back up again, that's a reversal. So what I'd have you do is count how many reversals on this screen do you see. So I see 1, 2, 3, 4, 5, 6, 7. Even though it's a doji, I'll give it 8. Yeah, so I've got 8 on this one. Typically, in this 1-year sliding window, I'll see anywhere from 7 to 12. You know, it varies depending on market volatility, that kind of thing. But the question I want to ask you, and this is the meat and potatoes of this study, is I'm going to keep the math simple. There's 52 candles here. I'm going to pretend it's 50. If I had 10 reversals where the price went up 1 week but then reversed went down the next week, if I had 10 of those reversals, 10 of the dreaded whipsaws, right, what's the failure rate? 10 out of 50 chances, let's say, is a 20% failure rate, as long as I'm doing my math right. And if I'm doing my math wrong, please chat in. Brian will be sure to correct me. So my question to you is, okay, that approach has a 20% failure rate. Is that good or bad? Well, the answer to that question comes a lot easier, I think, when I reverse the question and say, okay, it has a 20% failure rate, but it has an 80% success rate. Is that good or bad? With an 80% success rate, can you make some money? Absolutely. And ultimately, that's what we're trying to do, is identify the trend of the market so that we can put another chink in the armor, if you will, of putting the odds in our favor. At every turn, we're trying to put the odds in our favor, and we're just trying to identify what the trend of the market is and go with it. One of the things you'll hear me say time and time again is 1 day's bad market move does not make a trend. We're always trying to analyze the trend. And for us, the shortest trend indication we have is this week-over-week analysis of price direction. Because in Dr. DeLito's analysis, anything shorter, and because the market's been up 2 or 3 days, you're going to get in, you start chasing the market. This is also amplified in technical analysis, where of a week's market movement, the last bar of the week is considered to be the most important bar. Right? So it all dovetails in with market theory. Well, let's extend that logic. If 1 week going up is good, right, indicative of a trend, then if I have 2 in a row, that should be even better. 3 in a row better than that. 4 even better than that. Less likely to get whipsawed, right? 5 better than that. 6 even. Right? But the question is, what's wrong with waiting 6 weeks to make sure that you are in a trend that's likely to continue? Well, I'm asking this rhetorically because we don't have enough time for you to chat in the answers, but hopefully you answered. If you wait 6 weeks, you missed the move. If you wait, if the market's rising from this point and you waited till here before you got in, you missed all that. So in all of these market timing signals, the market timing signal that you're going to adopt as part of your trading plan, it's always a question of which signal gets me in fast enough to get the gain, but keeps me out long enough that I'm confident that the trend is likely to continue. And it's always that balance, and I make this analogy to jump rope when we were kids. You know, there are some people who, you know, you're playing double dutch jump rope and they jump right in, you know, after the first or second swing. That was my sisters. I was the kid because I had 2 sisters. I had to play with them, so I had to play double dutch jump rope. But I would sit there for like 5 minutes, and they'd be going, come on. But I want to make sure I understood the rhythm, right? Because I didn't want to make a mistake. So we are as investors, traders, we have different sensitivities to how aggressive we want to be and how much risk we're willing to take on by getting in early, which tends to whipsaw more often, right? Or waiting longer, which tends to be more secure but lower returns because you leave money on the table. In the VectorVest system, Dr. DeLito decided that magic time frame was 2 weeks. So we have what we call the 2-week rule, or you'll hear us refer to it as the preliminary signal of a sustainable trend. When the price of the VectorVest composite has gone up week over week for 2 consecutive 5-day periods, so Monday over Monday over Monday, that's a sustainable indication of a trend. We confirm that signal when we have more buys in the database than sells. And so we recently had a confirmed down call because the price had fallen for 2 weeks in a row and there were more sells in the database than there were buys. All of these timing signals and all of our analysis, in fact, are all driven mathematically. There's nobody in the back room who ever gives their opinion in the VectorVest system. The opinion is left for the views, right? The tool, this analytical tool, was designed by a engineer who said, you know, when you want to know the truth, you go to the data, right? And so VectorVest is all about crunching the data and giving us information that we can use. So that's how we developed or started this market timing system, with the primary wave being this change in the week-over-week price of the VectorVest composite. The 2-week rule then at the other end of the spectrum, with the confirmed call being our slowest or most conservative timing signal. So let's fill in the gaps, if you will, and let me change my graph here a little bit. We're going to change, from weekly to an end-of-day graph back to 1 year. Let's take off the confirmed calls, and let's just zoom in on this most recent market period here. All right, so let's start by going through, if you will, the order of signals. All right, so let's start with that primary wave. Here we have the market low. The first signal that I expect to see coming off of this low, my fastest signal, would be the primary wave. So now all these green and red arrows are primary waves up and down. The down would be when the price was lower on a week-over-week basis. And so you can see that, first of all, this signaled very close to the actual bottom. I'm only 3 days off the bottom before I got the primary wave signal. How many signals are here? 2, 4, 6, 8, 10, 12, 14, 16, 18, 20, 22, right? And this is only a 5-month graph. Typically you'll see, you know, in a 1-year period, if you roll back, and I like to kind of keep track of these things on a 2-year window, and then I count them up and average them. but typically you'll see anywhere from 50 to 70 of these primary wave signals change per year. Well, that, by implication, if you're going to trade that signal as your entry and your exit into the market, then that would signal that you're going to have an average holding period of about a week. See where I'm doing the math? And again, I'm keeping it simple. I'm a simple guy. If I have 50 changes of signal, I've got 50 weeks, then the average holding period is about a week. Well, that implies or has an implication of what kind of stocks are you going to try to trade on that signal to make a profit. If you only have a week to hold that stock before you see reversal, McDonald's is not going to make it, right? A slow, large cap, slow moving, steady eddy kind of stock is not going to make the gain that you need before you pay for your commission and slippage before you get the down call. So the fast signal lends itself to higher volatility, smaller cap stocks that really are going to make that move. And so a more aggressive trader might use this timing signal for their entries and their exits. So let's move to the next one. Our next signal is the green light buyer. Notice that in this case, the green light buyer, and actually let's talk about the green light buyer. The green light buyer is looking at that light here in the price column. So when this light turns green because the price has been up day over day and week over week and wasn't red the previous week, the day that this price light turns green, we'll have this green arrow generated. And sometimes you have several green lights in a row. And so now all the green arrows are green lights, the first green light in the color guard price column. The yellow lights are any yellows or reds. And the red light is our confirmed down call. You can see that we have quite a few green lights here, but in terms of if I was getting in on the green lights and out on the reds, I have many fewer than I did on the primary wave. So the analysis is a little tricky at this point, but this is a slower signal. What we're doing is slowing down that primary wave. To get the green light, not only does the price have to be higher than it was on a week-over-week basis, but it has to be higher than it was yesterday as well, and the previous light can't have been red. So think of it this way, as I'm slowing down that primary wave. And this is the first step below it, the second signal typically to trigger after that primary wave signal. The next step we take is we slow down this by trying to make sure that we have upward momentum in that price move. In our market timing system, we have RT, if you remember, and RT tells us whether or not price is trending upward or not. Notice how the RT, even though price was kind of holding still, RT was starting to fall off, showing us that we were losing momentum in that uptrend. And you can see that a lot where the price trajectory takes off, but then it starts kind of rolling over as it starts losing momentum. Well, you can look at the peaks if you're that good, but we came up with a market timing system called the RT kicker. And that is simply a couple moving averages that we put on RT, a 10 and a 15-day, and by virtue of their crossover, it tells us whether or not price is still accelerating upward. So when the short-term moving average crosses the long-term moving average, that confirms the green light in the price column. When the RT starts falling off, though, and the short-term falls below the long-term, then we stop confirming these green arrows because we say, hey, yeah, okay, price may be higher, but we're losing momentum. In other words, that uptrend is weakening, and that's not when I want to be buying stocks. And so we have then the RT kicker timing signals that does a very good job of helping us not buy back into a falling market. So again, we've come up with another confirmation or another confirming signal to slow down that green light. Our next signal is called the DEW signal. This would be the next signal that you would see fire off in the system. Now you can see in the DEW we have a 6-month graph here, and we've had 4 signals. Now 5. Right? So now I have 10 signals per year. I'm doing real fuzzy math here, I understand. So the DEW signal, and I'll show you here how it's derived, but if it has 10 signals per year and I've got 50 weeks, then it must be about 5 weeks per signal. So let's change our layout. And this signal is derived by looking at a couple technical studies. We're still looking at the VectorVest composite price, but we've applied two technical studies, the detrended price oscillator, and you can see them here in the layout bar. The detrended price oscillator is right here. And the important part, the white line is the 30-day weighted moving average. These outside blue lines are called envelopes. So D, E, and W. The signal is generated when the price of the VectorVest composite closes above or below that 30-day weighted moving average, and it's confirmed by the DPO going positive or negative. So we're looking at technical studies now based on the VectorVest composite price movement. The envelopes come into play to identify periods of extreme price action where you're going to get some reversion to the mean, if you will, and the rules change slightly. So I don't want to confuse you with those details. Just generally, the DEW signal is slower than the green light buyer RT kicker signal is. It generates about 10 per year, giving you a 5-week holding period. What I would suggest you do, by the way, is take a look at these and say, well, geez, okay, when it fails, how badly does it fail? How does it, how many signals am I getting per year? Let's change back to, I'm going to change this back to our traditional layout. And we talked about our slowest, most conservative timing signal, then the confirmed call, which again on this chart has 4, so typically you'll see somewhere anywhere from about 4 to 8 of these signals per year. And so I've got about 10 to 12 weeks per signal, right? And so as you see, as we go more and more conservative, if you will, or slower in these timing signals, the idea is you're farther and farther away from the turn, right? You're farther and farther away from the actual turn, but that's because you're trying to build confidence that this thing is likely to continue. By the way, in bull markets, by definition, the uptrends tend to be extended. The bear reversals tend to be short-lived. Right? The pullbacks, the corrections, if you will, tend to be short-lived in a bull market, which we define as one where earnings are rising. Bear markets are just the opposite, and I can show this to you fairly easily, I think. I'm going to screw back here to 2007, right, where you see the downtrends extend and the rallies are minimal. The downtrends extend and the rallies are short, right? So it's just the flip side when you're in a bear market. We define a bear market as a time when the S&P earnings are falling, right? And that psychology, which we don't have time to go into today, just falls right back into fear and greed in the market. So there we have it, the series of signals, if you will, all the way from the primary wave all the way up to the confirmed calls. Your job then is to identify which of those signals you want to adopt. But before you choose, let me show you one more thing that you got to know. I'm going to change our graph from 1 year to a 5-year graph. I'm going to put on my big friend, the MTI. And those of you who've ever taken a course from me or with me know that the MTI for me is worth the price of the subscription by itself, because the MTI tells me a lot. I like to say it's the smartest indicator in the box. What I'm going to do is I'm going to try to make this scale a little bit better so it's more obvious. But let's zoom in. Maybe a 6-month time frame here. Remember, the MTI's job is to show us, identify for us, the underlying trend of the market. It's on the 0 to 2 scale. The neutral line, this neutral line run through the middle, is 1. So that would be sideways market action. Downtrends are downward, uptrends are uptrend. And so the first question I ask is, let's look for correlation between market action and what the MTI is telling us. So the MTI is telling us the market was at a low. Was it? Sure was. Market's up. Sure was. Market's down. Sure was. Market's up. Sure was. So do you see correlation between the tops and the bottoms? Is the MTI doing its job of telling us when the market is up and when the market's down? Well, I'm going to answer for you and say absolutely. If you don't see that, then call me and we'll talk about it. Because I need to make sure that we're on the same page for that one, because we get to the next slice, I'm going to have you answer even more questions. Well, if that's good, the next step is let's look at the crossovers from downtrend to uptrend and see if those were good entry and exit points. So let's look at this first crossover. Was that a good time to get in the market? You say, but Todd, I did a little whipsaw reversal here. Let's save that question for just a second. Just in terms of the gross market movement, was that a good entry point? Absolutely. Was that a good time to get out? I'm going to say absolutely, even though you may be in the audience saying, well, no, man, because it started going right back up again afterward. Well, let's pretend you can't see any of this, right? All you can see is this. The market's been doing that. Do you know what's coming up on the right-hand side, right? At that point, the market is off of its high, right? It failed to hit a new high. What are you going to do? So is it doing a good job of, if you will, avoiding a disaster? I say absolutely. So carrying on that thread of logic, then that got us out. Here we got back in. We got out. We got in. Does it do a pretty good job of getting us in and out appropriately? Hopefully you're saying yes. But let's talk about those dreaded whipsaws. Right? Here's one right here. We're going to zoom in on it. So the market, or the MTI told me to get out here, right? So I went back to cash. I got out of my long positions because the MTI told me the market was starting to trend downward. How long was I sitting back in cash, or how long did I go short in the market even? 1, 2, 3, 4, 5 days. So here's the million-dollar question. Did you unravel your portfolio by being on the wrong side of the market for those 5 days? And by unraveling the market, or your portfolio, I mean, did you make a catastrophic mistake? Did you have a catastrophic loss in that 5-day period that meant you had to go back to work, right? That you could no longer play this game and that you had to recapitalize, right? The first rule of business here is to not lose, right? Well, I would suggest to you that you did not. If you would have made a catastrophic move in those 5 days, then you're not exercising proper risk management. And the point here is, when you do that, when you follow that basic concept, remember I have a mathematical indicator here, right? So here's that dreaded fall from 2007 to 2009. As long as you are never long, when the MTI is below 1, it's impossible for you to unravel the portfolio. Let me say it again for emphasis. As long as you don't ignore the MTI, it's impossible to unravel the portfolio. You may get whipsawed, but that's not where you unravel. Where you unravel is you say, oh, but it'll come back. See, I knew it. Here's the rally. We're back, right? The bottom has been put in. It's back to the races, right? Maybe not so much. So if you get this concept that the MTI is a mathematically driven indicator and it cannot be up when the market is down, you're a long way toward understanding market timing. And as long as you don't fight the MTI, as long as you don't ignore it, you can never unravel the portfolio again And by extension, our confirmed calls are just the same way. As long as you never ignore them, it's impossible for you to be on the wrong side of the market for more than 2 weeks. You will not unravel your portfolio ever again. 2007, 2008 are off the table. Subscribers to the VectorVest program who were with us in 2007 and 2008, who followed the system, will attest to the fact that they were able to protect their assets, certainly minimize their losses if they had them, and those who suffered them were hitting themselves on the back of the head because they didn't listen to the confirmed down calls. That's the power of what you have in this tool in terms of understanding the market's trend. Now, I want to come back here. Let's go back to our 1-year time frame. Taking off these calls. Obviously then, the MTI can be above 1, it can be below 1. We talked about trading the crossovers, but the best time for me to be buying stocks is not only when the MTI is above 1, but when it's above 1 and rising. Right? When it's above 1 but falling, I don't know if it's just in a little bit of a retracement here or if it's in an outright reversal. And I don't know either, right? I don't have a crystal ball. But what I do know is when the MTI starts falling, I may be in an uptrend that's weakening. I'm going to stop replacing. I'm going to stop buying new positions until the MTI stops falling because I don't know how far down it's going to go, right? I don't know how far down is. And if our mantra is all about buying rising stocks in a rising market, I don't want to buy the dip until I know the dip is done. There's a phrase in there somewhere. I'll coin it later on. All right, so here's another concept. I want the M to be rising when I'm buying stocks. When it's falling, I'd rather be shorting or selling or going to cash. What I'll also have you notice, and I guess I shouldn't have gone from 1 year, let's go to 5 year and see if we can get it. Absolutely. Notice that the MTI, when it gets to certain levels, tends to kind of max out, if you will. If I put on a horizontal line, recently it's been about a 1.5. Historically, we look for about a 1.6 level. So when the MTI starts getting up about 1.5, what does it tell me? It tells me I'm getting closer to the end of that uptrend than I am the beginning. And there are periods where it can go above and can stay above for a while. But generally, when I get to that point, you start seeing the market roll over, right? The uptrend rolls over and does a little correction, if you will, right? So at this level, at this 1.5 to 1.6 level, we start looking for a market top. The market's looking toppy, you'll hear us say. And the idea is that your upside is becoming limited, right? Your upside potential is becoming limited relative to the risk of a reversal. So that when this MTI gets to an elevated level, then it's time to stop replacing, right? It's kind of the same concept as that RT kicker. It's time to stop replacing, maybe tighten up your stops. If you got some big profits, shave them or take them off the table, because you're coming up to a riskier market period where you're more likely to see a rollover than you are to see price keep advancing. And if the market is doing this, we already know that most of the stocks correlate because by definition, if the broad market's falling, then 80% of the stocks are falling with it. Of course, in 2009, the only stocks with buy ratings at that point were contra ETFs. So that defines the top for us. At the bottom, we look for an MTI value of about 0.60, which historically, and this is just by historical observation, looking at the graph. Yes, there have been periods where it's gone below that level. But when the MTI gets down to that 0.60 level, we start looking for a bottom. In other words, our downside potential is becoming rather limited. It's too late to take on new shorting positions or to reload. It's time to start holding positions, take your profits off the table, tighten up your stops, maybe get your shopping list ready for the next up wave that's likely to come. This is particularly true when you have a buy-sell ratio. Right, when we look at the relationship of buy-rated stocks to sell-rated stocks, when that's extremely depressed, right, when there's been a hard sell-off, that selling pressure is taking the good stocks along with the bad stocks, and those can be very explosive up moves coming off of those oversold levels. There's all kinds of resources available on this bottom fishing technique, which is what we're doing here. We don't have the time for that today. What I want to establish for you, though, is that the MTI is telling us not only green light, red light, but it's also telling us yellow lights, right? It's telling us oversold and overbought, as well as, or topping and bottoming, as well as uptrending and downtrending. So that MTI level, if you will, can correspond or be very helpful in understanding what's going on kind of as a secondary indicator of the market movement. Some people say, well, gee whiz, I don't want to wait for the crossover. I'm just going to start buying stocks as soon as it starts coming up because I'm an early initiator and I want to get in right off the pivot point. Great. If you're a little more prudent, conservative, maybe you want to wait for that crossover. The crossover of the MTI, by the way, in frequency is about equivalent to the DEW timing signal. A little faster than the confirmed calls, slower than the green light kicker. So you have that concept then that I'd like to be buying stocks when the MTI is rising, or is above 1 and rising and strengthening, if you will. That echoes that first idea that we talked about with the RT kicker of I'm looking for a second way to confirm that my trading signal is strengthening, not weakening. And I can look to the MTI to find out if the MTI is trending upward or downward, strengthening or weakening in that signal. But I can also use shorter term signals to accomplish the same end. And this historically is what we had done prior to the RT kicker timing signal. Let's go back to the home page. Here we have in the color guard system timing signals, right? The primary wave and the MTI crossover, which is not a timing signal, but the confirmed call. Looking at the color guard, and I can actually even change this to bigger size, right? As we were coming up from this confirmed call, right, it started weakening here, and we saw that we had some primary wave changes to the down. You started seeing some green lights pepper in here with the red lights. Ultimately, the market started falling. We got the primary wave changed to down. This is a little bit out of order, but typically the first thing we'd look for is the primary wave to change to down. They all happen together here on the 11th. So the change in primary wave would be the first thing that we would typically see. That often correlates with a change in color in the price column, because the rules are for the primary wave to change, the price had to be down on a week-over-week basis. To get the red light, it had to be down day over day and week over week, and the previous week couldn't be green. So those all happened at the same time in this particular series. The next signal that I would typically expect to see would be this little asterisk, which tells us that that price movement was confirmed by the crossovers of the RT moving averages in our RT kicker timing signal. So you see how they're kind of lining up, if you will. The next signal would be the DEW signal, which we don't show on this chart, but it roughly corresponds to the MTI crossover. And then finally, you would see the confirmed call change from up to down. So if I'm looking for this trend to be weakening, the first thing that I expect to see change would be the primary wave change to up. One thing I would caution you, and we had an example of it right here, and we actually have another example today. When you see red and green together, it often is because you're right at the neutral line and you're oscillating above and below. So notice how we went from 111 to 1 to 0.94 back up to 1.28, right? So as you oscillate around that neutral line, I went from below 1 to above 1, so the MTI is flipping around here. Those neutral lines, you want to be careful, because what's the trend? If we go back to the market timing graph, oops. Am I still hitting a series of higher highs or lower lows? Right? What's going on with the trend? Well, right now I'm kind of in between the previous high and the previous low. Although certainly in the short-term trend, I'm seeing some weakening here. The MTI has been trending downward. We crossed back below before we had a little bounce here in the past couple days of price action. I'm always asking myself, what is the trend? And so what we have done historically, before we had developed the RT kicker timing signal, we always said, well, okay, if you're going to trade the DW signal or the confirmed call, then we're going to look to the short-term signal, the primary wave, as confirmation that that trend is continuing. And so you see in the views this reference that, with 3 red lights in a down-up situation. Well, that down-up tells us that the primary wave is down, right? So that's a weakening uptrend at best, right? And actually, I'd say this is oscillation. But just look at that one line. This is a weakening uptrend in a confirmed down situation. So the long-term trend is down. Now I'm trying to get that feel of, okay, am I bullish or bearish, and am I increasing or strengthening or weakening in that outlook? And for that reason, you'll never see us advocate buying stocks for any temperament when the primary wave is down. The only person who'd ever trade against the primary wave would be a day trader. Now, you may not use the primary wave as your confirmation. Maybe if you like the frequency of those confirmed calls and you want to make sure that there's a green light as your confirmation, or a green light with an asterisk that it's the kicker. That's all fine. You could use the MTI as your confirmation. The point here is you're going to adopt a trading signal that's the right speed, right, the right sensitivity toward get me in soon enough to get the gain, but keep me out long enough that I'm confident it's going to keep on going. Right? That's your trading signal. Then I'm looking for a secondary signal that's a little bit faster to help me identify if it's still strengthening or weakening. And I'm only going to buy and replace stocks when I've got my bullish signal and it's strengthening. As soon as it starts weakening, I stop replacing. Depending on how much of it starts, weakening more and more, then I start tightening stops. I start taking more defensive measures. This gives me a natural ebb and flow as the market ebbs and flows. I'm riding right along, we call it riding the wave. I'm riding the wave of the market up and down. And the question is, in terms of identifying the wave, are you looking at the ocean's tide? Are you looking at the waves on that tide? Are you looking at the ripples on top of the waves? Or are you looking at the sea foam on top of the ripples? I'm running out of analogies here, but in other words, time frame matters. Hopefully now I'm building for you, and I don't have your faces to get some feedback here, so hopefully I'm giving you more of a kind of holistic view of this market timing system and how you can see how it shows us strengthening and weakening marketing conditions. And we also, when we have time to go into it more fully, we can start reading into the tea leaves, if you will, and identifying turning points. What I would tell you, though, is every day, if you come right to the strategy section in the VectorVest views, and I've got the gadget here, we tell you exactly what you should be doing. Our guidance is driven by our analysis, in particular Dr. D's analysis of this timing tool. There are a lot of things that he can infer by identifying those turning points that may not be obvious to us. So I encourage you every day, look at that daily color guard report or read the views to get those insights. Hopefully, that gives you the tools, and I'm glad I've got a couple minutes here to answer questions. But you now have a methodology, and here's what I'd suggest you do every day. Is, first of all, look at the market timing system every night. Am I bullish or am I bearish? Right? Is my timing signal positive? Did it trigger? Or am I supposed to be sitting out? If I am supposed to take action, if I'm bullish or bearish, is that trend strengthening or weakening? I may have the primary wave, or the confirmed call may be up, but if I have a primary wave down, I'm not buying anything. Right? If something stops out, I'll sell it, but I'm not going to buy anything unless it's a trend that's strengthening. And then finally, check the MTI level. Are you nearing a topping or a bottoming market condition where you're likely to reverse? The key here is you only buy and replace stocks when the trend is strengthening, either upward or downward. Cash is a position. It's a great defensive position. When in doubt, leave it out. If you're not sure what the market condition is, then it's obviously probably not in a nice strong trend. just sit on your hands, right? Because again, the first priority is to retain capital. All right. With that, that wraps up my formal presentation here. Let's get Brian back involved and see if I can answer any of your questions, because, like I say, this is a gold mine right here.
All right.
You understand this.
Thank you very much, Todd. Before we move forward to just a few housekeeping things, I did place in the chat box a link to the recording just in case the email doesn't come through to you. Sometimes they get gobbled up by spam blockers and such. So the link I put in the chat box, just copy and paste and save it for an hour or so. The recording will be available then. And also, Todd just put up on the screen, those of you who are just happen to stumble upon this webcast and this is the first time you're seeing VectorVest, we do have a 5-week trial. It's $9.95. You could click on the link there. I'll put that into the chat box as well. And then before we get to the questions, there's some positive feedback for you, Todd, and for the content that you put through here. We had Jack say this is one of the most informative presentations that he has seen. So thanks for the feedback, Jack. John said, "Great."
Thank you, Jack.
John says, "Great class. You learned a lot." And Andy says, "Excellent presentation." So we appreciate all the good feedback from all of you. And Bob Hendy, excuse me, I shouldn't have said the last name, but Bob says, "Thanks for the presentation. Lots of good reminders." So I promised a few people we will get to. I'll get to your questions. So first off, Dan asks, what would you say would be the best call to use in buying stocks and maybe holding them maybe just for 3 or 4 weeks?
Well, what I would have you do is, let's not rely on me. What I'd like for all of you guys to do is go to a market timing graph and do a little bit of what-ifing, right? Had I done this, so I go to a 1-year graph, turn off the MTI, and I put on the confirmed calls, maybe I put on the DW signal. I start looking at this and I start saying, well, okay, where did it break down? Where did it give me a signal that I wasn't really happy with, right? Did it have the right frequency of signal for me and the right kind of holding period? If you're looking for that 3-week holding period, then you're probably kind of in the middle of the road, probably the green light buyer, RT kickers, probably somewhere in that right mix for you. But, you know, be creative here, because I could do something like, say, you know, I'm going to wait for the confirmed call because I don't want to get in right at the turn. Right, I want to come off the bottom a little bit before I start getting in here. But once I've got that confirmed call, I'll go ahead and refresh on those RT kicker greens. Right, so you could still have a relatively short holding period by putting the signals together in different combination. So hopefully that doesn't muddy the water, but in terms of when am I going to start, the trading signal is the one that you want to identify. And because ultimately your trading plan of when to buy, what to buy, and when to sell is driven by your market timing signal. A lot of folks ask me when I'm on the road and say, well, gee, you know, I just got this signal and I'm not really sure that it's really going to work. Take the signal. Your trading plan is going to be driven by a signal, and the reason you chose that signal was that you did due diligence and you're confident that it's going to work for you more often than not. And this game is all about the odds. It's Vegas, baby. Right? So you want a market timing signal that more often than not is correct and gets you in and out of the market appropriately for your risk temperament. Brian?
You ready? I was waiting for you to say over.
I am, yeah.
All right.
Yeah, that's my biggest problem. You never know when I'm done.
All right. Cold Dip, I hope I pronounced the name correctly. He says, what about shorting stocks? And he and I went back and forth a couple of times in the chat. And then he had a follow-up question because I was talking about the bull versus bear markets. He said, well, at what stage would you enter based on the MTI? So if you can touch on shorting stocks and also MTI levels or any other insight you might have on shorting stocks.
Yep. Same idea. And I'm in a bull market, right? So I know in a bull market that the uptrends are protracted, the reversals tend to be short-lived. The faster the signal I get, the closer it'll be to the actual turn. So there's confirmed calls relative to a primary wave, right? But in the same time it took me to have one confirmed down call, I had 3 reversals of the primary wave. So what's a boy to do? Or girl, right? You need to look at those signals and determine which signal for you on balance is the right one for you temperamentally. This might be a little fast for you, although a day trader says, no, that's perfect. You gave me 3 days of down market to play before it reversed. Great. The follow-up question to that is, once you've determined that signal, do you want to try to be the superhero that can make money on the downside in 4 days? There are a lot of folks who just temperamentally can't take that kind of volatility. Look at the size of that candlestick, right? That kind of, the sharp volatility and the sharp reversals, for a lot of folks, probably the majority of folks in a bull market, just sit out. Just wait for the market to clear. You're going to have some great buying opportunities when the market reverses, corrects. In the meantime, you don't know when that's going to be, so you don't want to be in the market, right? You're going to protect your portfolio, but you don't necessarily have to play the downside. If you want to play the downside, then this tells me I'm going to have to be nimble. Right? If I'm only going to have 4 days to make it in this little retracement, I didn't get the signal to the end of the day, so I really have 3 days to make it. So if you can trade that way, then great, there's an opportunity for you. Of course, as Brian was saying, once you get into the protracted bear markets, we made a lot of money with contra ETFs in 2007 and 2008. You did not have to be a genius to make money with contra ETFs in this market condition, right? So in the bear market, it flips. You instead were trying to be a hero and make money in that. Just look at the intraday volatility going on. I mean, the real bodies are open and close, right? So look at the spreads in price volatility within the day, and they were closing relatively neutral, right? It takes a little bit of a cast iron stomach to try to trade those two. That's in a bear market where fear is the predominant emotion, if you will, driving market action. So you just want to kind of know where you are and then decide how you're going to play it. With contra ETFs, I think it's even fair for a prudent investor to play in a bear market the downsides and still make money no matter what the market is doing, because it's not as fast and you have more time to be right. Brian, what was the part with the MTI?
It was just what level of the MTI would be best to enter shorting stock or shorting trades. So I was thinking either market top if you want to get in early, or maybe just stick with the old MTI going below 1. But get your insight on that.
Yeah, well, the closer you are to the turning point, again, the more risk you take on. So let's look at this point where we were in a topping market, right? So again, you're in a bull market, earnings are rising, so you're taking on a lot of risk by saying, okay, as soon as the market starts to fall, I'm going to short, right? You're taking on more risk by doing that. Conversely, if you go to look at those lows, right, you say, well, I'm going to jump in just because the market, the MTI started going up, you're going to take on more risk. So when you get to these oversold levels, and actually you can even make money on those dead cat bounces, but I digress a little bit in even talking about that. The closer you're trying to take advantage of those turns, the more risk you're taking on, and so the more likely you are to get whipsawed. You want to be nimble again. It's a much more aggressive road, and that's fine unless you're not an aggressive personality, in which case let's wait. Let's wait for the signal, and let's wait for the market guidance to line up.
All right, you got one more for you. Scott asks, and actually a good question, because some people do consider that there might be an MTI for stocks too. He says, since I can't buy the VectorVest composite itself, should I do the same type of analysis on an individual stock? Does the MTI make sense for an individual stock?
No. The MTI does make sense for classes of stocks. And this is more than I wanted to load you up with today, but the MTI level implies phases of the market. So in other words, small cap explosive stocks work well down here, where dividend paying, fat cats do well up here. That's a little bit more than I want to go into at this point, but come out and see us at a seminar and we'll certainly get it to you. You can call us in product support. I'm not playing games here, but that's a lot of information to take in on the first pass. But not a direct link to a stock, no.
All right. Yeah, well, to be respectful of everybody's time, we're a few minutes over our 1 hour, so I think let's wrap it up here. I did put the link in the chat box for the recording. And actually what I'm going to try to do, I'm going to see if I could do this, is actually even upload this video once we get it all done. Actually upload it to a place like YouTube, so that way it's there. Because someone, I believe it was Jerry, had typed into the chat box, said, hey man, you should show this for all new subscribers. So we'll get this so that it's there for eternity, and you get to listen to Todd forever and ever and ever. So I'm going to turn over to I'm going to turn it over to Todd so you can say goodbye. We look forward to having all of you back. Now, we do have a members-only Q&A session every Monday. In the U.S., we have it at 2 o'clock Eastern. If you're listening in from Canada, there's a Canadian one at 11 a.m. Eastern Time. Bring any of the questions we didn't get to today. Bring them to those sessions as well. We'll see if we can get to them in those. So I'm going to turn it back over to Todd. For me, good night, everybody. We'll talk to you soon.
Thank you, Brian. Folks, I put up on here at the end of the presentation our link to the VectorVest, or at least our address to the VectorVest University. Everything new is under the sun, right? We've been here before. We've talked about this market timing system dozens of times. The place to find out that information is in the historical views and in the historical strategy presentations that we've done over the past 5 or 6 years that are in the archive there. So, you know, go pick out a title that sounds familiar or interesting. You can learn a lot about the program by simply doing some of that research. Of course, we are here in the product support department free of charge to help you get on the right path. With that, hopefully I lived up to my promise. I gave you a couple of aha moments. I really hope I did. Again, I appreciate your attendance here, and hopefully my excitement was contagious. Thank you again, guys. Have a great night.